Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Sonia Shenoy and Pavitra Parekh. It's another day and it's another red tick on the markets. The Indian markets have been declining for the last 4 trading sessions, and since the start of the year, we managed to close in the green only twice. Rest all the days, the markets have been grinding lower. The good part is, from a bull's point of view, that we're still defending that 17,774 mark. Yesterday, we did breach it, but very quickly, the markets managed to close above that level, so which was a positive. So this level of 17,774 still continues to remain an important level. That said, we did breach it yesterday. And look at the way the tables have turned, right? Last year, India was outperforming, but this year, India is a stark underperformer. Week to date, Nifty Sensex are down close to about 0.3%, while the Taiwanese markets have gained 3%, the Korean markets have gained 4%. Outside of Asia, if you look at US as well, you've got gains of more than 6% coming in for the Nasdaq. So the tables have truly turned, and India is now a bit of an underperformer. So down day again, but again, it's not lost so much ground, right? We're still broadly within that range of 18,250 to 17,800, 17,750 on the way down.
I think today is a very important day, because despite a lot of good news being given to the market, it's just not responding, whether it's Infosys, whether it's lower FI selling, whether it's the good inflation data both from India as well as in the US. Despite all of that, the market is just not responding to positive news, which just goes to show that the texture of the market has worsened. The Nifty has now broken below that 100-day moving average, as we know, and it's heading towards that December 26th low of 17,774. That has been a crucial support for the index for a while. If that breaks convincingly on the downside, then of course there's perhaps a bigger opening, bigger slide that the market is expecting. I'm just watching out for a couple of stocks. Of course, we've been talking ad nauseum about Infosys and HCL Tech, but Wipro comes out with earnings today, and there's some weakness, some trepidation perhaps ahead of the numbers. Tomorrow you have HDFC Bank that comes out with its numbers, and it's going to be a solid set. There's a 20% loan growth expected. There is an asset quality that's expected to remain stable. But ahead of that, the stock is slightly, just a bit cautious. So keep that on your radar as well. But all in all, I guess today just goes to show that this texture of the market has really weakened because no amount of good news is really aiding it.
Well, absolutely. And, I guess it pinches more because for a while now, we've been talking about the resilience of the markets. We have been talking about how India is outperforming. And now that's really not the case. Reema was talking about how, Asia has done way better than the Indian markets. Take a look at how the US markets have moved. This is the weekly move that will come up for you. So you can see the Dow is up almost 4%. NASDAQ is up almost 7%. This is the kind of weekly move that we've seen for the US markets. And in that context, of course, it pinches a little bit more what's going on in India. Of course, IT is looking the worst on a day when you actually expected it to really support the market. Reliance continues to move lower this week. We have been seeing that. And what's holding up is definitely the metals pack. So that's adding a little bit of support to the market. I do have to point out that even on this, down day, we are seeing advances still outpace decline. Same thing that we saw yesterday, because there is news and good move in individual names like an RVNL. You have something like a Coal-Tea Patil, Cyient. We'll talk more about that in a bit, but that there is some good news, at least in these individual stocks. In terms of Qs, it is the earnings expected over the weekend and also the crude move that we are seeing. That will be key to track, with crude now at around $84 a barrel. So that is everything that we're tracking for the markets. But Reema, L&T Tech is one stock which I was just mentioning, and it's a sharp cut coming through there. We also have the management.
Absolutely. So first, let's just tell our viewers the news. Now, L&T Technology Services is, the company has announced that it will be acquiring Smart World and Communication business of its parent company, L&T. This acquisition will help L&T Technology strengthen its global reach across next-gen communication, which basically means 5G, sustainable spaces, and cybersecurity. Amit Chadha, the MD and CEO of L&T Technology Services, is now with us on the show now. Amit, morning, and thanks so much for joining in. This is Reema here. You've given an indication of what the synergies, the rationale for the acquisition is. To understand the financials, Smart World and Communication, calling it SWC, could you tell us what the margins of this business are and how would it compare with the margins of L&T Tech? Would this acquisition be margin and EPS dilutive for you?
So before I swing directly to the margins, I do want to take a couple of minutes and talk about the business itself. So if you look at what we've been seeing with our clients that we've been talking to across US and Europe and parts of Asia, is there is a strong demand momentum for electrification, energy transition, 5G rollouts. There's a demand for service-led models for efficient campuses, cities, utilities, mobility, public safety, and of course, cybersecurity, right? In fact, another just data point for you that the $1.6 trillion of engineering spend in 2021 was led by manufacturing 51%, or manufacturing companies, expected to, by 2025, go to $2.3 trillion, with 58% coming from high-tech and services. So that has been the rationale that we have taken to go ahead and acquire this business. I would like to confirm that in the medium term, this will be margin accretive and EPS accretive. But as you would agree with me, with such a large transaction, at about 1,000 crore rupees, about 110, 120 odd million dollars, with EBITDA of 8 to 10%. In the immediate term, there could be a little bit of a dilution, but medium term, we are reaffirming our guidance of this being margin accretive.
So you're saying that in the immediate term, this acquisition will be margin and EPS dilutive, and in the medium term, it will be accretive for you. Could you define what you mean by immediate? What is medium term? When do you think the margins of SWC can catch up with that of LTTS?
So I would say immediate term, as we define it, is a 1 year period. Medium term for me would be between a 2 to 3 year period. See, if you remember, Rima, we had committed, and I'm reaffirming that, we had committed in September 21 that we would be $1 billion run rate by FY23 Q2, Q3. We delivered that in constant currency in Q2. We had committed to an 18% EBIT trajectory, and we were able to achieve that right somewhere in that FY22 range, right? We didn't have to come to FY25 for that. We are reaffirming our 1.5 billion guidance by FY25 and being in that 18% range in the same period in EBIT terms. So EBITDA, of course, is higher.
So you reiterated the FY25 guidance. We understand that it's at $1.5 billion and 18% EBIT margins. But considering that this acquisition will straight away add about 13-14% to your top line, is there a case to advance your guidance?
Rima, what I can confirm to you is FY25, some point, it may well happen in the first quarter. If we can do it sooner, we will do it sooner. I am absolutely optimistic about the prospects this brings to us. Being able to design complete networks, being able to, provide an end-to-end cybersecurity offering, as well as tapping into investments that people are making in sustainable spaces, I believe can help us leap forward growth. So this is a forward-looking acquisition that we have made at this stage, the biggest one that we have done to date.
All right, you're confident on what this acquisition will bring to L&T Tech. But Amit, can you also elaborate on what the historical growth rates really look like for SWC?
It's a culled-out business from L&T. So it's not been a company by itself. We can send you some of the growth rates as you move along. But, just to keep in mind that they started in 2016 with zero revenues and have delivered about 1,000 plus crores last year. So in about 6 years' time, they've been able to build a 1,000 crore business. So you can imagine the kind of growth they have done. They've been largely in incubation, building a lot of capabilities that they've been doing.
So who are SWC's biggest clients, and are there any working capital issues at the moment?
I can confirm no working capital issues. Third, in terms of biggest client, they work for various governmental entities today. So T-Fiber, Tanfinet, BSNL, as well as various metros, if I may. They've been working with, including Mumbai, Ahmedabad, etc. So across India, they've been working.
Amit, could you comment a bit on the valuations? Because you are paying 800 crores for a company whose top line is almost 1,100 crore rupees. So how were the valuations arrived at?
We used independent auditors to come in and cross-check, give us a band of evaluation. L&T also did the same. We followed the guidelines as stipulated by governmental entities to arrive at a fair market value. We paid 0.7x of revenue trailing 12 months. And again, that's part of the release that we've already made. So we believe that this is and about 7.5 times EV to EBITDA is what's been paid, and we believe that's what has been guided to us, etc. And we arrived at that price.
And considering that this is a material related party transaction, was this the only available option for you?
We did look, and what we wanted to do was, we were clear we wanted to improve our footprint in the telecom 5G domain. We recently, if you remember, we bought Orchestra Technologies about 2 years ago. It was in the same area, but they provided us, if you may, the middle part, because we have the OEM part, they provided us the middle part. And now what Smart World brings to us to scale, right, is the architecting part that other companies do not have. Second, we also looked at the ability to turn this around. And given where we were and given where our clients were and what they were looking for, we thought this was a very sweet acquisition from that standpoint. Third, L&T comes with it with an innovation culture. When we do an acquisition, we want to make sure we're able to integrate things with not just scale, but speed as well. And this allowed us the ability with a common culture for us to be able to do that. So look at this as a scale and speed acquisition more than anything else at this stage.
Okay, you are looking at this as a scale and speed acquisition, but Amit, you've used a large chunk of the cash that you had available on this, around a third of what you had available has been used on this acquisition. What does this really mean for future dividend payouts, and what does it mean in terms of acquisitions as well?
We are cash positive. We continue to generate cash every quarter, every month. We have positive cash flows. So I am confident that dividends should not get hit, right? I don't have a problem there. We also continue to look at further acquisitions. If there is something beautiful that comes along that is worth it, that makes sense from a technology standpoint, because when we look at an acquisition, we look at market potential, we look at technology, we look at ability to grow and expand, and finally, can we integrate, right? Because you have to be able to do that to take this forward. So we will have all those options open. We also have various assets on our books, as you're aware. So I'm not worried about that at all. I do think this is a good move at this point of time. So it gives us the ability to run through next year and be able to grow and show the results and change.
Okay, we will leave it at that. Thanks a lot for joining in. Well, for the market, it is holding on to the lows of 17,770. Remember, this was the December lows as well. So for now, the market is holding on to that. Let's see how it goes. It's recovered a tad bit from the lows of trade. Let's slip into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta will be joining in. Stay tuned.
आज तबीयत ठीक नहीं लग रही, तुम ही सब काम निपटा दो ना। अरे टेंशन किस बात की? सेंचुरी एमडीएफ का लो एमिशन प्रीमियम प्लस है ना, हायर डेंसिटी है, वाटर रेजिस्टेंट भी है, यानी ये है जहाँ नो टेंशन वहाँ।
लो एमिशन प्रीमियम प्लस बाय सेंचुरी प्रोवुड।
For how long will you continue being tensed about the future? Pension can free you from future's tension. With LIC's new Pension Plus, make your own pension plan, because this plan creates market-linked wealth for your future. Moreover, this plan comes with guaranteed additions and also offers various options for receiving pension, so that you grow young and tension-free. LIC, हर पल आपके साथ।
तुम तो मेरी रोशनी हो।
तेरी रोशनी हूं मैं, किस ना। Once an investor has assessed their financial goals, timeframes, and risk appetite, the next step is to formulate a sound financial plan. It is important for investors to understand features of the financial products and whether they suit them, their investment philosophy, and risk profile. Smart investors do not base their financial decisions on tips, rumors, hearsay from neighbors, acquaintances, friends, or anyone who has anything to say. They do their own research or take advice from qualified and credible financial advisors. Always remember, it is important to choose the right financial products to meet your specific financial goals.
NSE द्वारा निवेशकों के हित में जारी।
Welcome back to Trading Hour. As promised, we have Manisha Gupta joining in to tell us about some commodities that's on her radar. Manisha, what are you looking at today?
Sonia, thank you for that. Well, I'm looking at a SEBI circular which clearly is positive for the commodity participants and for exchanges as well. So exchanges actually had presented to SEBI the need of multiple contracts in the same commodity, and that's exactly what the SEBI has now allowed as per a notification that came in last evening. So this means that you will be able to do, and this would actually encourage broader participation of in various commodities on the exchanges itself. The contracts will also had restricted earlier a lot of participation, and now the presentation in case is that if you are trading in gold, you may not want a larger contract of gold, so you could trade in gold mini, a gold guinea, a gold petal contract as well. So there are various gold contracts within that one commodity on MCX. Now with this, you will have this kind of opportunity in various other commodities as well. You perhaps will be able to see a silver mini and silver coins contract as well, and similar situation could happen with crude and various other metals as well. The contract actually comes into effect with immediate effect, and we have spoken to exchanges. They tell us they have already been working in this direction. So perhaps from next month onwards, as and when SEBI approval comes in for these contracts, you could be looking at more contracts within that one commodity itself.
All right, Manisha, thanks a lot for getting us all of those details. We do have to get into a short break now, but before we do that, here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investors, that empowers you to make the right decisions with your money. Now, as a stock investor, I'm sure you've seen stock tips through SMS, emails, YouTube videos, Telegram, and several other social media platforms. But did you know that wrongdoers use these channels to pump and dump stocks as well? Well, I would advise you not to act on it blindly. A smart investor always conducts adequate research, analyzes risk, and consults only SEBI-authorized investment advisors to make an informed investment decision. You should go one step further, in fact, and report any unsolicited stock tips to the exchange. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is still around 30 points in the red, but there has been a sudden spike in some stocks, some of the IT names actually. So Infosys is at the high point of the day. You have TCS also, which has moved up a fair bit. HCL Tech does continue to, trade under pressure, but it has again moved up to the high point of the day. But let's now talk about a CNBC-TV18 exclusive. We learned from sources that vendors are likely to consider seeking advance payments from Vodafone Idea for Jan 2023. This is Jan 2023 and onwards. Ashmit is here with all of the details on this one. Ashmit?
Well, the situation appears quite grim for Vodafone Idea. Firstly, we had, of course, the clarification coming in from the telecom minister himself that there is a need for funders to put in more money, for promoters to put in more money. Then there was, of course, news that we broke earlier this month, wherein the bankers have refused to extend further liquidity to Vodafone Idea. Now we understand that keeping in mind both these factors, the vendors are not seeing a lot of confidence going ahead in terms of payment, and therefore are likely to now ask Vodafone Idea to pay in advance its dues beginning the month January 2023, which is this ongoing month. This is, of course, on account of not just these recent figures, but also in the recent past. We've seen that Vodafone Idea has had a checkered history in terms of making payments, especially payments on time, and that has been a big grouse that a number of vendors have. Companies such as the tower companies, the ATC, Industars, or whether it's telecom equipment suppliers, all of them have had expressed concerns to Vodafone Idea with respect to outstanding dues. For instance, if we were to talk about Industar, what we're also given to understand is that in their upcoming board meeting, which is scheduled for January 24th, they may even consider drastic measures such as discontinuing services if in case no payment comes through for Jan 2023. And that is something that will be quite grim as far as Vodafone Idea is concerned. And this, of course, comes on the back of falling subscriber base as well. We saw, as per TRAI data, that for the months of September and October, just these 2 months alone, Vodafone Idea lost about 75 lakh subscribers. A lot of important circles such as Himachal, J&K, Northeast, Odisha, there are less than 20 lakh subscribers in some of these circles, and that has caused a lot of concern. So clearly, worries appear to be mounting for Vodafone Idea. Back to you.
All right, worries mounting for Vodafone Idea. Thanks a lot, Ashmit, for that. Let's get Mitesh Thakur into the conversation now, because the market has attempted to recover and is for now holding on to its December lows. Mitesh, welcome back. You know, the problem is that the texture of this market has weakened quite a bit, and the expectation is that even the December lows could be taken out. Is that your view too? And if yes, what is the way to approach the market for the rest of the day?
Sonia, we've been maintaining a negative bias, but suggesting that given the fact that from late December, we have had about 5 instances wherein the Nifty has, on intraday basis, traded below 17,800 but not closed below it. So I think that breakdown is not happening. The structure slightly on the weaker side till we get some signs of reversal. I think we'll maintain a mild negative bias with the possibility of 17,800 being eventually taken out, and then Nifty could possibly slide to lower levels. So, the idea is that trading with more of caution. If you're trading longs, the stop losses are very tight, while aggressive shorting will be done either below 17,800 or on a bounce back to about 18,100, 150 zones. Having said that, the stock calls that I have, Granules is, Aurobindo Pharma is something which is breaking down, so that's a sell. Keep a stop at about 441, look for targets of 415. While metals is something, which has lent a lot of strength and to the markets and have been outperforming. So Tata Steel is a buy with a stop at 118 for targets of around 126.
All right, got it. Mitesh, thanks a lot for joining us for that quick check on the markets. But with that, let's move on. And now we're going to put the spotlight on banking MDs. Now, a host of managing directors' terms are due to end in 2023 from the banking space. So Abhishek is standing by at the big wall with some very interesting details. Abhishek.
Well, Pavitra, 2023 marks a big year for the banking sector when it comes to lenders at various entities. As many as 8 lenders could see their managing directors' terms ending in 2023. So for some of them, the board has already given an extension, but RBI approval is pending. RBI could have a relaxation in terms of, extending some of the current MD's position or tenure as per suitability. So RBI has a ceiling in terms of age for the role of MDs and CEOs and whole-time directors as well, which is about 70 years. So also RBI has put in another rule that a lender cannot have an MD and CEO position filled by the same person for a maximum of just 15 years. So above 15 years, they will not give permission. Let's now focus on some of the lenders who may sign off completely from the banking sector in 2023. The big one is Mr. Uday Kotak of Kotak Mahindra Bank, and the other one is Mr. Mahabaleshwaram, MS of Karnataka Bank. Mr. Sanjay Agarwal will be completing 15 years as the MD of AU Small Finance Bank. He was appointed as the MD of AU Bank way back in February 2008. Now, some of the renewals for another term as MD of the bank from the board is pending with RBI. So, current age, let's take a look at that also. Bank of Baroda's MD, Mr. Sanjeev Chadha, is about 58 years old. Bank of India's MD, Mr. Das, is 58 years old. IndusInd Bank MD, Mr. Sumant Katpalia, is 60 years old. The youngest in the list is Mr. Sanjay Agarwal of AU Small Finance Bank at 52 years of age. Karnataka Bank's MD, Mr. Mahabaleshwara, is 63 years old. ICICI Bank's MD, Mr. Bakshi, is about 61 years old. SBI's MD, Mr. Dinesh Khara, is also 61 years old. Kotak Bank's MD, Mr. Uday Kotak, is 63 years old. Back to you.
Okay, thanks a lot. lot for that. So the MDs of banks are in the spotlight. We'll slip into a short break. On the other side, the IT space continues to be in focus. So more on that in a bit. Stay tuned. Welcome back. You're still watching Trading Hour on CNBC-TV18. Well, HCL Tech is the top loser on the Nifty despite earnings that beat estimates in the third quarter. The sector as a whole is falling today as analysts say that the guidance remains muted and visibility of growth in FY24 remains quite hazy. Earlier today, we caught up with the management of HCL Tech to understand what the growth could look like for the company going ahead. Listen in to what they had to say.
From next financial year, we see a strong uptick in the retail CPG segment. And that's also enabled by the new bookings, which is a couple of deals that we announced. We announced ODP, we announced Mattel, both are in the retail CPG segment. Both of them will give us good headwinds, good tailwinds in the Q1 of next year. There is a 70 basis points improvement in the operating parameters. So it's been an exceptional quarter of execution where we delivered efficiency in the operating model, whether it is freshers, automation, and better utilization, all of that. So I think that's really talking about the key levers that we have for improving margins, whether it is freshers, whether it is improving utilization, improving realization. All those metrics are a very, very sharp focus for us. And that was the logic of providing a roadmap of getting to 19 to 20% margin profile.
There is no deal cancellation for sure. Even I don't think we said that there is a slowdown in deal making. We said, deal wins continue to be decent, and that's what we announced yesterday. $2.35 billion is a very good number for us. And you're absolutely right. We have been in that narrow band of $2.5 billion every quarter on the trot for at least the last 5-6 quarters. So I would not say deals have slowed down. Yes, there are some. I mean, Europe is one geography we talked about, but at an overall level, we are not seeing a slowdown.
Okay, that is the management of HCL Tech. But Infosys is, of course, also in focus. The company beat estimates in the third quarter. They've also revised the full-year revenue growth guidance upwards, and they maintain the outlook on the margin front. The deal pipeline also remains healthy for the company at over $3 billion. Ritu Singh spoke exclusively to Salil Parekh, CEO of Infosys. So let's listen in to that chat.
So on the guidance, we've had a very strong large deals win for Q3, and we've had very strong growth in the quarter, 13.7%. Keeping those factors in mind, and also looking at the points where some of our industries we are seeing a different economic environment. For example, in financial services, in mortgages or investment banking, in telco, in high-tech, retail, so on. Keeping all of those factors in mind, we've increased the guidance. Specifically on Q4, we don't provide a quarterly view of that. We only have an annual guidance.
That's right, but the implication is because you revised up the guidance for the rest of the year, will we see a bit of a muted growth? And also, if you could comment on, the EBIT margin, you expect to be at the lower end of what you guided? On the Q4, so first, with the change in the guidance, typically Q3 and Q4 are seasonally weak quarters for Infosys in any case. So those factors still continue. On the margin, we had a very good operating margin in Q3 at 21.5. We've kept the guidance, which was narrowed to 21 to 22. We've kept it at that level. And we've also made the statement in the comments earlier, it'll be at the lower end of the guidance.
Okay, the other stock that is moving around is Cyient. In fact, it would be interesting to pull up Cyient stock because in an environment where all the IT stocks are under pressure, the Cyient stock is up about 0.2%. It's not surging, but it is at least outperforming the rest of the pack because of a strong performance in Q3. The dollar revenue surged nearly 13%, while the margins have expanded to 13.2% from 10% in the previous quarter. And another key positive, the deal pipeline also looks strong with 5 new large deals in the services segment. To discuss more on this, we had a chance to speak to Krishna Bodanappu, who is the MD and CEO of Cyient. Let's listen in to what he had to say.
Of course, there are certain industries like semiconductor which are slowing down a little bit, and we just will mitigate against that. But some of our large industries are doing quite well. Therefore, from a demand perspective, at least that 3.5% number that we see, at least that demand, we will see acceleration of that. We'll actually see meaningful acceleration of that. We're quite confident that within the next year, we'll at least get to the mid-cap average.
Okay, that is the management of Cyient, and that's everything that we're tracking from the IT space. But let's get into a short break now. When we come back, we're going to discuss the market fundamentals. Unmesh Sharma of HDFC Securities will be with us. Hey guys, welcome back. You're still tuned into trading. The market is still seeing a 30-point cut right now. It is the mid-cap index which is under pressure right now, and it's underperforming. So that one is down over 200 points. That is for the mid-cap index, and we're pretty much at the low point of the day there. The Nifty Bank also trading with a cut of around 0.25%, but it is really IT which is proving to be the big drag today on the market. So that's what's going on with the markets. But let's get a conversation going now. Unmesh Sharma, head of institutional equities at HDFC Securities, joins us now. Unmesh, good morning and thanks for joining us. This is Pavitra. It's definitely not been a good start of 2023 for our markets. What do you make of it? Even on a day like today when all global cues are positive, we got a good handover, it's still just refusing to take that and, build on any kind of gains. Do you think this is just a period of consolidation and this kind of downward pressure is likely to continue?
We think so, yes. It's not a short-term period of consolidation in our view. Our view since last August has been and continues to remain that the market continues to face significant external challenges. That is not something which has changed. In fact, it seems to be playing along exactly how we think. The market in general seems to be looking for news to prove that the Fed has finally or will finally make a pivot. So, that's really the term where everyone seems to be using these days. And if you may recall that since August, there have been times where people looked at either the commentary from the Fed or they looked at what's been happening in the inflation prints, including what happened last night, and trying to put a positive spin to that. And then what happens is that the commentary from the Fed is that, it's going to be higher for longer, plus you start getting a little bit of hiccups in terms of what will happen to inflation. So I think this fight between the bulls and the bears, so as to speak, on whether there is going to be more hawkish, more dovish, or whether it remains, hawkish for longer, it continues to remain, and which is what is leading to volatility in risk assets across the globe, and which is what seems to be affecting India as well. We don't see that ending in the first half of this year.
Okay. How are you feeling, Unmesh, about the IT companies? The companies have indicated to us that there are still some growth headwinds. Client decision-making has been delayed, and certain pockets like Europe have not recovered yet. Would you be cautious here, or do you think at some point in time it's good to get into these names?
Yeah, so look, our research team had put out a report on the demand. This was about 6 months ago, where they had said that things had started to improve, but at the same point in time, there would be problems on headwind. The other issue is that in the very short term, even if you do get some good news, like, a guidance raise or something of that sort, the big issue is that, again, macro, which is that are we going to get a soft landing? Because that is what will affect growth, which affects the demand scenario for the IT companies. So from that perspective, our core view is that it's a shallow recession in the US and possibly, deeper in Europe. This is our house view. In that sense, we continue to believe that there could be some more cuts to demand estimates going forward as well. Having said that, in that scenario, in our model portfolio, we are starting to, cut our underweight position on IT a little bit. And the key reason for that is that thankfully, unlike the start of last year, from valuation perspective, we seem to be in a slightly better position. We think that till we get clarity on earnings cuts, we won't go overweight, so we continue to remain a mild or underweight on the sector.
Okay, got it. By the way, a lot of these IT companies, the likes of Infosys, are at the high point of the day. Infosys is now one of the top gainers as well on the Nifty. But Unmesh, what do you make of the banking pack, the kind of pressure that we've seen, especially on names like ICICI, Axis? What do you think? Do you think the rally is it's pretty much done, or is this just a bit of a pause here?
So in an overall scenario where, clearly we are negative on the market, I think everything has to be seen in that context. But within that, the one space where we are relatively the most positive on, and that's also our largest overweight position in the model portfolio, is the large banks, the large private banks, which includes the ICICI Axis pack. Now, is that going to be good enough for you to be able to deliver alpha on your portfolio? I think they will outperform. In this scenario, however, where generally there is some pressure on the market, we believe there will be a volatility, but at the same point in time, relatively we would be positioned within this space in the market.
Okay. How are you feeling about the auto sector? There's a lot happening here. There's a big recovery in demand in certain pockets like commercial vehicles. Exports continue to be under pressure. So in this entire, under this umbrella of stocks, what are the spaces that you still like?
Yeah, so unfortunately, it's not been an easy space to navigate. Earlier there was this entire issue of chip shortage. Then we had the issues that we are seeing in the rural, and then you had some concerns around the urban consumer itself. We, however, have certain specific positions within that. For example, what we are saying is that looking at the way in which the sowing is happening, that hopefully the worst of the rural stress is behind us. And on the urban side, while of course there is a base effect which will start to kick in, but at the same point in time between that, we should start to see a little bit more benign environment as far as the entry level is concerned. So from that perspective, we are a bit more constructive than we were earlier, and that's a little bit more macro call that we have taken on the rural side, relatively, as compared to what it was 6 months ago.
Okay, and what would you think of a defensive play, something like a pharma over here? Do you think that this is a good place to put some money?
Oh, yes, absolutely. So you can tell from the general conversation that we are having that we are in we have a risk-off kind of mindset. What we are effectively trying to do here is looking at relative value within sectors. We're generally avoiding high multiple sectors, and positioning ourselves a little bit more on where we have better visibility on the demand scenario. From that perspective, pharma does play out well. We were underweight, I think, a little bit towards the first half of last year, which we have kind of cut to a more neutralish to a slightly overweight position also. Yeah.
Okay, all right. We will leave it at that. Thanks a lot for joining us, Unmesh. Have a great day, and of course a great 2023 as well. Well, for the market, very quiet really. So we've recovered a tad bit from the lows, but are still holding with cuts of about 30 odd points. Let's take a break, but here's some important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the entire list of stocks that you need to know for 2023. Okay, since the market is a bit quiet, let's talk about some mutual fund data. While SIP inflows have been healthy through 2022, there is a related data point that doesn't look so good. Pavitra is here at the big wall to tell us what that is. Pavitra, over to you.
Well, thanks a lot for that. We've all been talking about the steady SIP inflows over the past year, and there has been a good growth. So the graph will come up for you, and you can see all through 2022, we have been moving up. This figure that came through in December is the third straight month that we've been above the 13,000 crore mark. But a closer look at the data will show you that things don't look quite as encouraging on the SIP account front. So for all of 2022, new account registrations were up 5.7%, so it came in at 2.57 crores. The cancellation saw a big jump of 36%. This is versus last year, and it was at 1.36 crores. So if you look at all of this together, while new account registrations are up 5.7%, there's a sharp rise in cancellations as well. That's up 36%. And with this, the net SIP account addition is down 15% from 2021. So that is something important to track. So that figure has come in at 1.22 crores. Another point for us to track is the SIP cancel to registered ratio. Now, there's been a big jump here as well. It's come in at 52.7%. This is for 2022 versus the 41% that we had in 2021. This ratio was particularly high in the month of December. This data just came out, and it was at 66% for December, which is a very high level, 25-month high, in fact. And for the past entire year, that is for all of 2022, this ratio has actually stayed above that 50% mark for 7 out of 12 months. So do keep that in mind. Now, what this really brings us to is that while the SIP contribution looks good, there is really some more to read in the data, at least on the account front.
Okay, well, thanks a lot for that. That's very important data points over there on the SIP inflows. So we expected perhaps that the SIP inflows are strong, but a further look through or a deeper analysis indicates that perhaps it wasn't. Earlier today, we had a chance to speak to Mark Matthews of Bank Julius Baer, who discussed the global trade setup and gave his insights on inflation as well as India's returns. Listen in to what he had to say.
The inflation reading yesterday for the month of December was in line with expectations. No surprise there. Therefore, I think there's no more need to raise rates even now. And our view is the last rate hike was in December. That is a non-consensus call, I know. But if we are right, and I think it's sensible to think that, then rates are being priced too high. I'll just give you an interesting statistic. Over the last 30 years, India returned 9% per year in dollars, including dividends. China returned less than 1%. And past returns are not indicative of future returns. But I suspect that India's performance in the future will still significantly outweigh China's. I'm not talking the next 6 months, but I'm talking, the next 6 years.
Okay, with that, it's a wrap on Trading Hours. Stay tuned. Halftime report is coming up in just minutes from now.